Foreclosure rates are at an all-time high, with homeowners struggling to stay afloat, holding on to their one-time American dream. Banks are now helping Bay Area homeowners avoid foreclosure so they don't pile up with company-owned properties in the midst of the mortgage crisis. Mark Sussman is the Senior Vice President of Gateway Bank, a federal savings bank in San Francisco. He joins us live from our San Francisco newsroom to talk a little bit more about the issue. Thanks so much for joining us this morning.
Well, thank you very much. I appreciate the opportunity.
Well, a lot of people need help. How willing are banks to cut principal and drop some interest rates for homeowners these days?
Well, they're extraordinarily interested. The key here is there are two documents that you need to bear in mind. The first one is a forbearance agreement, and the second one is a mortgage modification agreement. Both these documents require a hardship letter, the reason why you're going into default, the reason you're going into a foreclosure position. Banks and lenders are looking for a reason this has happened to you. You've lost your job, there's been a death in the family, there's an illness. You need to motivate them to help assist you. The forbearance agreement, as the word says, it forbears, it does not forgive. So if your mortgage payment is $2,000 a month, you can negotiate with the bank to reduce it by 50% or greater for a period of 6 to 12 months. At the end of that time, you can take the differential, and we'll say the difference is $1,000, and add a little bit each month until that's paid off. Then your mortgage gets current and your credit stays good. The worse your credit becomes, the more your cost of funds become. So it's important that you maintain the best possible credit. Traditionally, after the forbearance agreement is completed, you have a mortgage modification. A modification typically adds any arrearages onto the back of the mortgage, and then your mortgage is increasing, actually. So if you had a $500,000 mortgage and you're 3 or 4 months down or 5 months down, your $500,000 mortgage may become $510,000, $515,000.
Right. Because so many people who were enticed by some of these loans, they're in over their heads when the rates went up, story after story, that people, they just couldn't afford to pay anymore, so they didn't, and now they're in kind of upside down. How do they ever get ahead? Because you mentioned you got to have good credit. Some of them have ruined it. Well,
you've got to go forward. Bad things do happen to good people. The thing that you have to bear in mind, particularly the advent of the 100% mortgage, the 80-20s.
Right.
People have gotten into houses that they paid $400,000, $500,000, $600,000, $700,000, $800,000 on an 80-20 type of mortgage, and their value is now lower than the amount, the value of the house is lower than the amount of their mortgage. Does that mean you should leave your house? Absolutely not. What people keep forgetting is that you have a tax deduction because of your mortgage interest payment, and houses will recover. I've been doing this for about 30 years, and this is the 4th time I've seen this happen. Unfortunately, it's going to get a little bit worse than it's going to get worse than it is right now. Most economists are agreeing that we're going to see a continued deterioration of the marketplace, but it's going to recover. We will see the return of better times. We'll see a return of appreciation of value. So you need to take the steps to call your mortgage servicer. You need to take the steps to call the mortgage bank, the bank, whoever has your loan, and tell them you've got a problem. Until you take that first step, nothing is going to happen. It's up to you to do that. They are responsive to this even more now than before. When a foreclosure takes place, everybody loses.
What about the responsible person who had good credit, maybe took advantage of one of the loans, but they have some equity in their home? They're looking for a good rate. Are banks more apt to lend to them more than ever, or is everyone being scrutinized at a much higher level? Is it tougher to get some of these jumbo loans that virtually everyone in the Bay Area has to have?
There's a change in the marketplace. If you go back 6 months, 9 months, 12 months ago, there was a lot more of the stated income, stated asset type of loan, higher LTV. People are pulling back. They're becoming more conservative on the lending side. Because of that, it's becoming more difficult to do some of this type of lending. But you still need to approach it. You still need to go out into the marketplace, and there are these loans that are still available. As long as your credit is good, the higher your credit, the lower your rate. That's what it comes down to. There is a economic stimulus package that the federal government is promoting. There are some changes to what's called the GSEs, which are Fannie Mae and Freddie Mac, where they may increase the loan amount Historically, well, last year it was $417,000 for a single-family house. Today it may go up to $750,000. So those jumbo borrowers can now go to conforming rates, and conforming rates today, as of this morning, are under 6% for 30-year fixed. So that's very, very aggressive.
Exactly. All right. And that's exactly what homeowners have to be as well. If they want to remain to be a homeowner, be aggressive. Mark Sussman, thanks so much for joining us this morning.
My pleasure.
Right now, we'll check in with Mike.